Hello and welcome to Expert Bites on moneypuzzle.in. This is going to be our very first episode on equity investing. Moneypuzzle.in is an online personal finance content platform catering to the money concerns of the young and restless. Joining me today for this episode is somebody who needs very little introduction beyond his name, S. Naren from ICICI Prudential Asset Management. Naren, of course, has nearly, I think, 3 decades of investment experience in equities. He's extremely passionate about this. And from what I understand now, he is even more passionate about sharing the benefits of long-term wealth creation through equity through his funds that he manages at ICICI MF. Hi, Naren, welcome. Thank you for joining us on this episode. Naren, so as you heard, this is a platform for young earners who are just starting their savings and investment journey. And what I wanted to really touch upon today is how equity can be used as a long-term wealth creator. Now, you've had a different experience, but a lot of people still consider this a gamble. You pick a good stock, you win; you pick a bad one, you lose all your money. Why should one come to equity when it comes to creating that long-term wealth, for years to come?
So I consider myself a creature of the equity market. I started working in markets in 1989. Wow. And I've spent 10 years in broking, 4 years in investment banking, right. 1 year in project finance, and the balance 15 years in equity fund management and debt fund management recently. Right. So I believe that equities is an absolutely great asset class. The challenge with equities is that many people invest in it in some years and don't invest in it in other years. I have done a number of meetings where I have discovered that most of the investors have come in 92, 94, 99, 2006-07, right. and 2017-18. The reality is that the people who invested only in these years, they lost the money. Yeah. They were 90% of the customers. Wow. There was a 10% who invested in other years, like 2002, 2008, 2013. And that entire money was made by this 10% who invested in other years. Mm-hmm. So that's why as a mutual fund industry, we have actually been popularizing SIP, because the problem is not with equities. The problem is not with the long-term investment returns in equities. Yeah. The problem is with the fact that people invest in it is like looking like weather. Yeah. And that is not a model which works.
You can't look back at returns and then, yeah.
You have to invest when you have a situation where come what weather. Yeah. People do other things. They should also invest in equity. So it is very important that each month they allocate a certain part of money to equity. The new generation has possibly a different set of career profiles and things like that, but that doesn't mean that they shouldn't invest each month in equity. And it can't be dependent on whether the market is in good shape or bad shape. It has to be invested.
You've seen all the cycles, so you know this very well, that I think what you're saying is that people try to time it out. If something is looking good, then it must be bought. But what you're saying is that that's not the way to approach it. And we have to be regular and do it today, tomorrow, yesterday, at all points in time.
Yeah.
Yes?
You have to treat it as a basic necessity. Actually, savings is a basic necessity. And equity is an integral part of savings. And that's why SIP is a basic necessity. And it can't be like in 2002, I say markets are doing very badly, let me not invest. Right. If you look at it, 2002 was the best year to invest. But that year, how many people invested? If you look, you'll find it's a very narrow fraction compared to the number of people who invested in 2007. So that's why people say if you look at the 40-year returns of Sensex, apparently it is 18% and Sensex came into being in 79. But the investor experience is far away from 18% per annum.
I think perhaps now with the access to managed funds like yours, maybe that will change in the next decade. The investor experience, also being closer to what perhaps the index or the benchmark is.
No, I have a different view. I believe that it's websites like you, behavioral finance, these kind of things which can force it, because there's a global problem. Okay. You might think US is the most advanced country and therefore people will do systematic investing when the markets crash. That's not true. So I believe what is required is tools like your website and behavioral finance and the ability to battle emotions. So like what Warren Buffett says, equity market is a market which transfers money from the impatient to the patient. So the question is that you have to be patient, and in a year like 2002 or 2013, you should continue your SIPs or add to your SIPs.
So be regular and be patient. I think that's what we hear. That's how equity can help you out. Now, the other thing is that people often also get scared with, the actual price that they see. So I might intuitively know, for example, a company like, say Maruti. You see it everywhere in India, and you might think it's great, but when you go to buy it, it's like 7,000 rupees on the screen. Now, for some people, that's their monthly saving. So they'll say, I'll buy one share of Maruti. It doesn't make any sense. So they get scared of the price as well. Now, why is it that one needn't focus on price, because that may not define the future value, and you could perhaps even buy that one share because return is return, right?
Exactly. I think people unnecessarily want to invest at par. There is nothing. Finally, it is the price to value gap which determines how much money you make in investing. So if NAV is high or low, it hardly makes a difference. It depends on what is the component of stocks in that NAV. So I think slowly that part of it, I think people have actually moved on. See, if you go back to 90s, there used to be something called a market lot. And that market lot used to be 50 shares. So if you had to buy a share which was 7,000 rupees, it meant that you had to invest 3,50,000 rupees. Whereas if you invest in a share of 10 rupees, it meant 500 rupees. So I think what has happened with the advent of NSDL and the fact that you can buy one share, if you take mutual funds, you can do small SIPs. I think slowly that part of it is at least changing, and people have realized that it has been worthwhile to invest in the best performing companies and not to invest in these penny stocks, because in every bear run, many of those penny stocks go bankrupt.
Yeah, and don't recover after that.
You
keep waiting that, that 5 rupees will become, truth is I've tried that out, it doesn't work. Really doesn't work. The 10 rupee stock you think will become 20 and you'll benefit, but it doesn't work. Okay, Naren. So I think I want to touch upon one last thing, and which is and you mentioned you're also on the debt side now, but the last thing is on balance. Equity works well in the long term, helps you create wealth. Then why do we need any other asset class?
See, I was a fund manager between 2007 and 2009. And it was a very depressing period, because in 2007 people got overexcited with equity. In 2008 they got depressed about equity, and in 2009 there was a massive bull run. And after the bull run, we went back and asked ourselves, what could we have done better as an organization? And we realized that the most important was to actually focus on funds which can invest in equity and debt. And that's how this entire category called balanced advantage was popularized by us. So for example, we are big believers in the asset allocator theme. So I had a chance to talk in my 25th year reunion of my IM batch, and I was given only 5 minutes to talk. It was like a 5-minute TED talk to my classmates of 25 years. So, and the topic that was chosen by my friends is investing. I told them it's simple, just do asset allocation. And if you do asset allocation systematically, you're done. Because asset allocation means in 2002 and 2013 you invest in equity. Asset allocation means that in 2013 you don't get hyped by real estate. So I think it's such a simple thing, and I tell people there is only one mantra that I have from my 25 years post my campus. It is that just practice asset allocation and just do asset allocation. Don't worry about markets, enjoy your life. Just do asset allocation and enjoy your life. That was my mantra to my colleagues.
Great, thank you, Naren. So there you have it. If you want equity to work for you, you need to be patient. You need to be regular, and you need to just invest. And if you want investments to work for you in general, asset allocation is your answer. Naren, but I'm not going to let you go. Just one last thing, because we are starting out at this momentous time where elections, the polling has started now, and pre-polls we've seen the markets kind of hold up pretty well, I think. Any calculated guess on post-poll or even scenario analysis that you might have indulged
See, the
in?
global experience from New York and London is fund managers can't predict elections.
Yeah,
And
that's why it's a calculated
but
guess.
fund managers can tell you that you do asset allocation. And if you're not doing asset allocation today and saying I won't invest in debt and credit, then you're not doing what is the mantra. So I would say ignore elections, focus on asset allocation. And what is asset allocation? Investing in debt and credit as well.
As well. Excellent. There you have it. There is no getting away from it. Asset allocation is your answer, really. Thank you so much,
Thank you.
Naren, for joining us on this, and it's been a pleasure talking to you. Thank you everyone for tuning in, and do keep logging into moneypuzzle.in for all your personal finance.